Welcome, everybody. Thanks for joining this afternoon. I miss seeing many of you at the various shows that we usually attend throughout the year, and so glad to see some familiar names on the list of participants here today. And for those that are new, welcome. Let me give you a brief overview of Nutter and myself before we get going. So Nutter is a full-service law firm located in Boston, about 150 attorneys. And we have a client base that's kind of all throughout the country, not just New England, but all over the country and even outside of the US. And our food and bev practice is really a soup to nuts type of practice. Everything from corporate finance, commercial deals with distributors, co-packers, brokers, IP support, and all the way on through to exit for a lot of our clients. We work with folks at the very early stages of their brand as they're sort of just growing and seeking national distribution. All the way on through to companies that have sort of secured that foothold and gotten that national distribution to even larger scale brands, wholesalers and distributors and tech companies and folks that you may not have even heard about, but nonetheless you're probably eating their food almost every single day. And the fun part of what we do is helping a lot of those companies succeed and get to an ultimate exit. And here's a few that we've had the pleasure of working on over the past couple of years. The team is about 25 or so attorneys. Here are some snapshots of us from better days when some of us would wear suits to the office. But full service firm, like I said, with support through employment, IP, tax, litigation, really anything that you can think of, we do with respect to the food and bev group, except really regulatory and label review. But everything else, Nutter is your one-stop shop for that. Here's a picture of me with a happy smile on my face. I'm a partner in our corporate and transactions group. I co-chair our emerging companies practice group, as well as our food and beverage group. And so I work with startups through their whole life cycle. Most of what I do is working with entrepreneurs, founders, and high growth startup companies, navigate the many pitfalls that are along the way from formation all the way on through to exit. So that's Nutter in a snapshot. I will encourage all of you to ask questions throughout the presentation to the extent that it's something that I'm going to cover later. Maybe we'll get there later, but if not, there's going to be time at the end for questions. But I encourage you to the extent that I'm on a topic and there's a specific question that you want answered, submit it, and I will do my best to answer it in real time. The presentation will be provided to you afterwards, so you'll have all this information in your hands after the presentation. So what we're talking about today really is equity, convertible notes, and sort of how both of those things are used in the growth of a startup company. People often use phrases and words all the time around equity, and oftentimes they're using it incorrectly or without really a full understanding of what they're talking about. So this presentation is really meant to provide an introduction to equity, to sort of answer those very basic questions about what it is, how you should think about it, how you can use it to grow your business, and it'll prepare you for future conversations with founders, co-founders, team members, folks that you're thinking about issuing equity to as the company grows, as well as investors who are the main folks that you want to talk to as it pertains to equity. So So what is equity? Simply put, equity is really the right to certain economic interests and control rights in the company, right? In the true sort of property context of the word, it's a bundle of rights, both economic and control. When used kind of generically, when we're talking about stock or equity, we're including all different classes of stock, including common stock and preferred stock. If you're an LLC, you might hear the term percentage interest or membership interest or unit, but we're all talking about the same things here, which right, economic and control rights in a company. And so the first area where I see folks kind of get things wrong is in this distinction between authorized and outstanding stock. So authorized stock is the maximum number of shares that the company is hypothetically allowed to issue at any given point in time. So one of the first things that you're sort of met with when you're forming your business is deciding how many authorized shares of stock you need to create when you're filing your paperwork with the Secretary of State of Massachusetts or Delaware, or whatever state you're located in. For the most part, the authorized share total has very little practical effect or significance. It's mostly used when calculating your franchise tax that you owe with the Secretary of State of Delaware. But other than that, the number really doesn't matter. And founders will often, approach us here at Nutter or members of the team here, and they'll have questions around, they've authorized 1 million shares out of the gate, and they've issued themselves 500,000 shares, say, hypothetically, and they're concerned that they haven't issued themselves enough stock because the way that they're looking at it is, oh, I only own 50% of the stock. I own 500,000 out of 1 million shares that have been authorized. But like I said, the authorized share total is insignificant, and the only number that you should really be concerned about is the outstanding share total, right? The shares of stock that are actually issued by the company at any given point in time. So in that scenario, that hypothetical that I just described, there's 1 million shares authorized, but only 500,000 have been issued. And so the number that's important is that 500,000. And so of the outstanding shares that have been issued, the founder owns 100% of those shares, right? All 500,000 that are outstanding are held by the founder. And so that's the number that we care about, the percentage relative to the shares that are outstanding. And why does that matter? Well, a second way that founders often get things wrong right out of the gate is they think about the issuance of shares to team members, to co-founders, to investors as transfers from their own holdings, which is wrong, right? So if you were to go onto your Fidelity or E-Trade, portfolio, your the website, and you're dealing with public company shares, then in that scenario, if you were to buy shares or sell shares, you would be doing so from another shareholder, right? No money or services flow through to the company. There's no change in the company's capitalization, and probably in most cases, the company doesn't even know that it has happened, right? That is not what we're talking about here and what we deal with in early stage work. We're talking about issuances. So on the pre-side of the column there, that is the capitalization of the company before any additional shares have been issued. So this assumes that there are 3 founders, A, B, and C, and they collectively own 900,000 shares of the company. Shareholder D comes into the picture, and whether for cash or services issued to the company is issuing a new set of shares to that new shareholder, right? A new slug of shares is being issued from the company to the new shareholder, the result of which is there is dilution to the existing shareholders, right? They used to own 100% of the outstanding shares, and now they own something less than 100%. So that is the concept of dilution. It's percentage dilution, but hopefully it's not value dilution, because right, the cash or the services that the new shareholder is contributing has hopefully increased the value of the company to some degree. And so we'll talk about that more as we move forward, but that is the basic premise of what we're talking about here, is new issuances of shares. It is very rarely the case that the founder will issue shares himself, right, or transfer any portion of his holdings to new folks as they come on board. We're always talking about new issuances from the company. And we're talking about really two flavors of stock: common stock and preferred stock. Common stock is we're talking food and beverage terms here. It's really vanilla, right? The base level equity in any company. Usually issued to the founders and the team members as the company grows. Maybe the company will be able to convince early investors to buy common stock, but really this is the base level that's issued to founders. Sometimes founders will come in and say, we'd like to be issued founder stock. And founder stock isn't really a thing. What we're talking about here is common stock, right? The base level stock that entitles the holder to 100% of the assets of the company upon liquidation, after paying all creditors of the company and any senior equity that might exist. Investors, instead, right, unless you're able to convince them that they should hold common stock in the company, they're most likely going to receive a senior class of stock called preferred stock that comes with a senior preferred right of return prior to the payment of common stock on an economic basis. So founders might come in and say, hey, that sounds pretty good. Why don't I issue myself some preferred stock? And the answer is usually because the investors can see through that, and they will ask you to either change all of that to common stock before they invest, or they'll make a class of senior of preferred stock that's more senior to the stock that you've given yourself. So they're ultimately in control of the terms that they're willing to invest on. And out of the gate, I always encourage founders to keep things as simple as possible when they're setting up their organizational structure, when they're thinking about their cap table and equity issuances, because the simpler things are, the more likely it is that things will go smooth when you're talking to investors. All right, so with that in mind, we're talking about common stock as the vehicle that you'll be using to attract team members and other co-founders potentially after the formation of the company. And so you'll be issuing it in one of two different ways, either as restricted stock or stock options. And we'll talk about the differences between those two, but which one you choose will likely be dependent on sort of where you are in the company's life cycle, and sort of what the value of the shares is that you're issuing. So restricted stock is simply a grant of stock by the company to the recipient. They receive the shares of stock on the date that they're granted. They typically have the same rights as all of the other holders of common stock. Maybe you can create two classes of voting and non-voting, but otherwise, with respect to economics, they are identical. They're usually subject to risk of forfeiture, what's sometimes called reverse vesting, and they're taxable upon vesting. And so that's where this becomes, this is where the rubber meets the road, as it were, right? If you're issuing these types of shares early in the formation of the company, when the value of business is relatively low, restricted stock probably makes a lot of sense, right? You get the equity in the hands of the holder. They start their holding periods for capital gain tax treatment down the road, and they're shareholders of the company on the date that they receive it. The IRS will always take the position, right, that if you're giving somebody something in exchange for services, it is compensatory in nature. And so if you're giving somebody shares of stock in exchange for services, and those shares of stock have real value, the recipient may be met with a tax liability that they were not anticipating, and that sort of defeat the purpose of the incentive equity that you're giving to them. So if it makes sense early on, restricted stock is a great way to get equity in the hands of those folks. But at a certain point in time when the company has real value, whether through actual sales or because the company has raised money from outside investors and a valuation has been pegged, with respect to the business, a certain point will arrive where restricted stock no longer makes sense, and instead the company flips over into granting stock options to their team members. So unlike restricted stock, it is not a present grant of stock. It's a contractual right to buy stock in the future, but the benefit is that you're able to use the price set today. So not a stockholder until the option is actually exercised and the recipient comes out of pocket and actually pays the exercise price for those shares. But the upshot for the recipient is that you defer the taxation event until the future, which is the exercise of the option by the recipient. So it's not the granting of the option that results in a taxable event for the recipient, but instead the exercise. And so the strike price has to be at least equal to the fair market value of the shares that are being received. But it's a good way to get equity into the hands of folks and not burdening them with a present tax liability. There's two types of options: non-qualified stock options and incentive stock options. We won't get into the details of how they differ, but they come with different tax benefits for the recipients. Regardless of which you choose to use in granting to the team, vesting of the options or reverse vesting of the restricted stock is absolutely crucial. It's crucial for retaining employees, right? Incentivizing them to continue working with the company and making sure that they're actually earning the equity that you're granting to them. And avoiding a situation where you've got a bunch of dead equity on your cap table, where you've given equity to employees or service providers that was vested upfront and they left, right? They didn't work out, they left, they quit. But they left with a big slug of equity. That's not in anybody's best interest, especially the companies as they're looking forward to raising outside capital. Those are big red flags for investors. So subjecting all equity to vesting is usually a good idea. Typical vesting terms tend to be 4 years with a 1-year cliff, which results in 25% of the award being fully vested after 1 year, and then the rest vests either in monthly or quarterly installments over the remaining 36 months. And so, right, the upshot of that is that if you've got an employee that doesn't work out for whatever reason and leaves before the end of year 1, then none of that equity has vested. And so it all returns back to the company and can be used to hire that person's replacement or for future needs of the company, and it's a good way to protect against, like I said, that the dead equity on your cap table. Mostly you'll see vesting really just based on time, right? Time-based vesting, but occasionally you'll see it tied to specific milestones. And that's usually in like sales type roles where the real value that person provides is not just being on the payroll and doing the job at all, but actually generating results. And so You'll often see those folks have milestones that are tied to specific achieved benchmarks, whether with respect to revenue or key accounts or things like that. But regardless of how you structure it, you should always put it in place, and you should also consider it for the original founders as well, especially if there's more than one of you out of the gate. Right, you don't want to be in that position where two of the three of you are pot committed and make it your full-time gig, and the third founder loses interest, but still has all of the same equity as everybody else. Investors will probably require it at some point as well, that if you haven't subjected your shares to vesting, that they'll put such an arrangement in place as a condition to their money coming in. And so putting it in place at the formation of the company shows goodwill on your part, and is a good step to think about when attracting investors. All right, we've got a question asking to elaborate on the reasons why a company would issue restricted stock. So I think I went into that a little bit, but right, the shares are called restricted stock because they are subject to vesting effectively, right? They're subject to a risk of forfeiture. They're not owned outright on the date that they are granted. So that's why they are restricted. And the reasons, like I said, are to make sure that you're doing everything that you can to retain your employees and your service providers, and to incentivize them to continue working, and make them have to earn the shares that you're giving to them. You can use vesting for employees. You can use it for independent contractors. You can use it for advisors, directors, really anybody that's performing services for the company, regardless of the type or scope of those services. If you're relying on that person to do a job, subjecting the shares that you're giving to them in compensation for those services, and requiring them to be subject to vesting, ensures that you are getting the benefit of the bargain, right? They don't get the shares unless they have performed the services that you have been, that they've been expected to perform and that you've contracted for them to perform. So vesting makes sense all across the board. There's ways to soften sometimes the heartache that folks have when met with the suggestion that their shares be subject to vesting, and that's by layering in certain acceleration type provisions, right? Giving them the benefit of vesting upon the occurrence of certain events, and it's usually in connection with a sale of the company, right? If my shares are subject, to 4-year vesting, and I've been hired to help the company get to an exit, if we get to that exit before the end of year 4, I will have done my job. And the fact that my shares have not vested shouldn't impair me or prohibit me from receiving the benefit of that bargain. So things like single trigger or double trigger acceleration, or adding in acceleration clauses that protect against being terminated without cause, are ways to get folks over the hump when trying to broach the subject of vesting. All right. So question has come in. Is it common to issue equity upfront for those that have put ideas and maybe an early product design together and will play minimal or no role going forward? Sure. So, right, time-based vesting only makes sense if the recipient of those shares still has work to do, right? If you're relying on that person's continued service to the company to justify the size of the award that they're receiving. If you've got early founders who have put in cash or who have contributed very specific IP, and that's the only contribution that they'll be making to the company, then right, maybe vesting does not make sense for that person. but you're probably solving for that in different ways, right? That the amount of shares that they might be receiving may be less than other folks that might be part of the founding team. All right. Okay. So we talked about common stock and how it is the likely vehicle through which you will compensate the founders and early team members. And as we mentioned, right, it might be possible for you to convince investors to invest into common stock. We work with a company who was able to raise a lot of money from outside investors, including strategic investors, just through common stock. But it's pretty rare to find that, and most investors will be investing into a new class of stock called preferred stock. And so the thing that makes preferred stock preferred is that there's a liquidation preference tied to it. On a liquidation of the company, on a sale of the company, preferred stock carries with it the right to be paid before other classes of stock, right? So it's usually a downside protection for the investor that worst case scenario, maybe not ultimate worst case, but right, in a scenario where there's cash that's actually being paid for the business and distributed to the shareholders, they will at least be able to recover the full amount of their investment before anybody else starts to receive anything. So I'm going to skip ahead quickly before I go back, and we'll think about it here. We'll talk about that concept here through this hypothetical. All right, so in this hypothetical, we've got an investor who is willing to put money into the company on a $900,000 pre-money valuation. For whatever reason, this company has almost knowingly issued 900,000 shares, the result of which is that it ends up in a nice $1 per share purchase price, right? $900,000, the pre-money valuation, divided by 900,000 shares, the number of shares that are outstanding prior to the investor making his investment. So works out to nice, easy math, $1 per share. Then the investor is putting new money into the company, $100,000, which leaves us with a post-money valuation of $1 million, right? The 900,000 pre-money plus the $100,000 that the investor is putting in. The investor has 100,000 shares. There's now 1 million shares outstanding, and the investor has 10% of the company, right? And here's what that looks like on a cap table, right? The founders owned 100% before that money came in. They owned 100% of the 900,000 shares. They still own those 900,000 shares on a post-money basis, but there's been an additional 100,000 shares thrown into the mix, which equals 10% of the fully diluted capitalization of the company, right? And so preferred stock, as we just talked about, comes with that liquidation preference where the investor has the right to receive their money back off the top. So in a hypothetical exit, right after the company raised that $100,000, if the company were to sell for $500,000, what's the result for the investor, right? They would take back their $100,000, right? They usually get the better of their money back or their percentage ownership. So as between $100,000, right, their invested capital, or their pro rata percentage ownership, which was 10%, $100,000 is a better deal than $50,000, so they'll take their liquidation preference in that scenario. Sometimes that liquidation preference is expressed as a multiple, right? So it may not be just they get the better of their money back or their pro rata percentage, but it might be they get the better of 1.5 times or 2 times their invested capital or their pro rata percentage. And so that, right, this changes things dramatically, right? It's amazing how many things can be changed, right? If we keep the value, the pre-money valuation of the company the same and invested dollars the same, that 900,000 number and that 100,000 number, we can keep those the same, and we can toggle a number of different levers here, and the result is that the investor gets a whole variety of different deals depending on where those levers are pulled throughout the process. And so understanding that as you go into the process of raising money from outside investors becomes hugely important, especially if you haven't done it before, right? Because they have. And so surrounding yourself with folks that have done it before and can raise the flags and identify the places where things are not as they seem becomes wholly important. So hypothetical, second hypothetical for you here is we worked with a company not that long ago that raised $15 million of cash. And for whatever reason, for a number of different reasons, they agreed to pay their investor a 2x multiple liquidation preference. So what that means is, right, instead of just getting the better of $15 million or their ownership percentage, which was around, I think, 33%, they negotiated for this 2x liquidation preference, and that changed the economics of the deal so that now it was they get the better of $30 million or 33%. So the first 30 million, off the top is earmarked for those investors. And an interesting thing starts to happen at that point, right? Right? If deal size starts to not matter in that scenario, exit deal size, right? So you can imagine that with those sets of facts, if a buyer were to approach that company and say, "Hey, we'd like to acquire this thing for $60 million," that's a pretty good deal for the investor, right? They will have just invested $15 million. They have a 2x liquidation preference, and so $30 million off the top is theirs. Contrast that with a situation where, right, the same company, doesn't get that offer, but instead grows the business over 5 or 6 years to get up to somewhere around, $100 million business, and they get an offer to sell that business for $100 million. From that investor's standpoint, right, if they're taking 33% at that point of a $100 million deal, they would have been better off, several years earlier, just taking the $30 million off the top. So interests are not always aligned, and these types of economic incentives for investors really change the way that deals look and are structured. And you might think, oh, this company sold for $100 million. There's, the founders are on a beach somewhere sipping cocktails and enjoying, the next phase of their life. But that might not always be the case, right? If they had raised a lot of money, that had multiple liquidation, multiples on the liquidation preference, then it's possible that original founding team actually left with not much at the end of the day. So that's a liquidation preference. Investors might also try to add a dividend, a negotiated annual rate of return into the mix here, right? They might say, hey, founder, you know how hard it is to raise money because you're doing it right now. Well, we're a venture capital firm, and we've also had to raise outside money into our fund. And our cost of capital is maybe 7 or 8% per year. So we need to add in an 8% accruing dividend into the mix here to make sure that we're getting our annual rate of return for our LPs. And so, right, that gets added, and that just adds another economic lever into the mix. So it's no longer just money invested or 10% anymore, right? Pro rata percentage. Now it's cash invested plus 8% per year, or 10%. And so it might not seem like much today, but if you've raised a lot of money and the company's sort of been chugging along for 5, 6, 7, 8 years, then that 8% potentially becomes a real number. You guys remember School House Rocks, conjunction, junction? Sorry. Hooking up words, making them sound right. Turns out that that the difference between or and becomes really important in these deals as well. So what I had just been talking about, the better of invested capital or pro rata percentage ownership, that's what's called non-participating preferred stock. You get the better of those two, the better of those two. Some investors have decided that and is a better conjunction, right? They like and a lot better than or. And so they will implement a vehicle called participating preferred stock. So it's no longer just the better of invested capital or percentage ownership. It's both. It's I get my money back first, and then after that, I get my pro rata percentage ownership. Right, so huge difference. So in that deal that we just talked about, where there was a 2x liquidation preference, if that had been participating preferred stock, that first $30 million would have come off the top into the investor's pocket. And then at the back end of that waterfall, they would have also shared in 33% of whatever was left after that. So obviously a significant impact on the economics of a deal. And by the way, the difference between those two types of provisions, right, that participating and non-participating stock, the difference is a sentence in a term sheet and probably one paragraph in a set of documents probably 3 inches thick. So knowing what you're agreeing to and making sure you've got advisors surrounding you that know what to look for in those circumstances becomes really, really important, like I said. Preferred stock also comes with other protections besides the economic ones, anti-dilution protections. Sometimes they have redemption rights. And importantly, they also come with certain control rights, both at the board level and the shareholder level. I won't get too much into the weeds on that, but right, we defined stock or equity at the beginning as a bundle of rights, right? Both economic and control. Turns out that statutorily, equity, right? Stock does not really come with the right to vote on too many things, absent an agreement among the shareholders to the contrary. So unless you have a stockholders agreement in place amongst yourselves that agrees that certain threshold level shareholder votes are necessary to perform certain actions, then most decisions are just made at the board level. And so investors will likely change that and put certain controls in place where they have the right to approve things both as a shareholder and as a member of the board of directors. So that's preferred stock. I'm going to pause and look at some questions that have come in while I was rambling about preferred stock. Are dividends common in typical early stage VC investments? Seems onerous on top of other preferred terms. So they are not uncommon, and they become more common depending on who you're raising money from, right? So if you're raising from venture capital, who has raised from their limited partners, it might be uh, more common to see it in that situation than it is from angel investors, right? Individuals or high net worth folks that are investing into your business that don't have similar requirements with their limited partners. Is it smart to keep a lion's share ownership position in a new company or give it up to investors along the way? Well, that is the age-old question, right? If you can form a company and become profitable without having to raise outside capital, without diluting yourself as the founders of the company, that's certainly the preferred way to go, right? If you can find bank debt or other alternative sources of capital that won't dilute you along the way, God bless. Good luck. You should definitely do that. The reality, though, is that for most early stage companies, that's not an option, right? You don't have the cash to pay folks market rate salaries. You probably don't have the credit worthiness to obtain lines of credit from most banks. And so, right, outside investors using equity as a tool become really the only realistic ways to grow a company along the way. We always say that no business has ever gone under due solely to dilution, right? So when faced with either shutting things down or taking money from investors and diluting yourself as the founder, that's usually the preferable course of action. But right, dilution is not without risks. All right. Talked about all this stuff. All right, and so we talked about the levers that investors can use to change the economics of a deal. They can do that through multiple liquidation preference, by adding a dividend, by making it participating preferred. Another way that the economics can change without changing any of the variables, right? The valuation stays the same, the amount of invested capital stays the same. Another way that you can see a lever pulled and value shifting from your side to the investor's side is by putting in place a stock option plan as part of the deal. And so same set of facts here as before, except instead of 900,000 shares outstanding prior to the investment, there's now 1 million shares because the investors have said, hey, we would like you to put in place a 10% option plan on a pre-money basis because we think that that you need to expand the team. Our investment thesis is predicated on you having in place some additional team members, and you're going to have to grant those folks some equity to get them on board. And so let's add a hypothetical 100,000 shares to your column for purposes of the stock option plan. And so that's the only thing that has changed, right? We've added 100,000 shares on a pre-money basis. And so the 900,000 is still the same, but because we're now dividing that by a larger number of shares, the price per share that the investor is paying has gone down, right? It used to be $1 per share. Now it's 90 cents a share. And so the dilution has been suffered exclusively by the founders, right? Investors still own 10%, but the founders have gone from owning 81% to 9%. So the plan is usually something that you're going to want to put in place, right? It's not a bad thing to have that reserve to attract team members, but the conversation and the analysis that you need to do is when does it come in? Whose column should it be in, right? Who should suffer the dilution when it's put in place? Is it just the founders or is it everybody? And so the investors will more likely than not tell you that it dilutes the founders only. And so it's calculated on a pre-money basis. All right, so that's equity. We've got about 15 minutes left. And just to sort of summarize what we've talked about, preferred stock results in an investor buying a known percentage of the company at the closing, right? We've landed on a valuation. We know how many shares are outstanding. We know the amount of the investment that the investor is making. And that results in the the recipient receiving an agreed upon number of shares. Usually comes with control rights and some other things. But there's ways to take investment from outside investors without having to agree on what that valuation is today. And the most common way to do that is through a convertible note structure, right? So the thesis of the note is that investors will provide capital to the company today for an indeterminate amount of equity based on later events, right? We're going to punt on valuation today, and we're going to settle on whatever the next round valuation happens to be. That allows companies that are growing at a high clip to really avoid suffering dilution that comes from taking money in at a lower valuation. The investment is treated as a debt of the company until the debt is converted into equity. So it's debt until it's converted, and it's best used and designed to be a bridge, not a pier, right? Notes should not be used as a means in and of themselves to raise money. They should be used as a tool to get you from point A to point B. And point B is the point in time where the debt will convert. So in exchange for punting on valuation, the investor is taking additional risk, right? They're giving you cash and agreeing that it's going to convert into an equity at a price to be set at a later date by people other than the note investor. So in exchange for that additional risk, they are going to get a discount on the price that the next round investors have set. A couple of other key terms of convertible notes. Notes generally bear interest at a rate of 5 to 10% per year. That just accrues. There's usually no obligation to pay interest currently, and the accrued interest will also be converted into equity at the time that the note converts. It's a balloon payment. This is not a mortgage or rent. It's not a traditional loan. There's no obligation to pay anything currently until a conversion. The note is treated as debt. It's usually unsecured, meaning that it's not. It doesn't have the benefit of any collateral, and it's almost always automatically subordinated to any bank debt. So if you have convertible notes that are outstanding, and then you go to get a line of credit from a traditional bank, the notes will be automatically subordinated. Maturity date of convertible notes tends to be somewhere between 12 and 24 months from the original issuance. So the key things to keep in mind here when you're thinking about convertible notes is how the investor gets the benefit of the risk that they're taking, and it comes in two ways. It comes through the inclusion of a cap and the inclusion of the discount. So how it works in practice is the investor agrees that in exchange for the cash that they're giving you today, they're going to get the better of an agreed upon valuation, a cap, or a discount against the price paid by the next investors in the next round. And so caps are good for investors, bad for the company. I'll say that again because it's important. Caps are good for the investor, but bad for the company. That said, the presence of a cap is pretty market, and it provides protection provides protection to the investor against what we call the idiot factor. And this, right, they're protecting against certain situations where the founders might know a guy who's willing to put money in at an egregiously high valuation. Right, the note investor wants to be protected against that scenario, right? A brother-in-law deal, or a relative deal that prices something favorably and eliminates the benefit of bargain that note investor originally negotiated for. And so the cap protects against that. but the cap should really, if you're using a cap, it should be higher than the price that you're willing to sell at today, right? If the cap is $3 million and somebody offered you a $3 million equity deal today, you're better off taking that equity deal because it comes with less risk and downside than the convertible note does, right? The cap is downside protection for the investor. The company can do no better than that cap in that scenario. So if you agree to a $3 million cap and the investor gets the better of a discount to the next round or the cap, in order for that discount in order for the cap not to come into play, you'll need to raise cash at a lower price than the cap, which is not good. And in order for the discount to work, you have to raise money at a price 20% higher than the cap. So in any way that you slice that up, right, the cap is preventing the potential upside that the company benefits from by raising money from outside investors. So setting a cap at a price that's higher than the current value becomes important. There's a couple of different ways notes will convert. The most common is a qualified financing. That's what we were just talking about, right? That the note automatically converts when you raise money again at certain thresholds. But the investor will also have the protection of maturity date and sale. So in the event of a sale, the investor wants to make sure that they're getting taken care of. And then maturity, right? From the company's perspective, you really want to make sure that because this is debt, you never want to be in a position where at the end of 24 months, because you haven't been able to raise money for whatever reason, and the notes haven't converted in accordance with their terms, you don't want to be in a position where you have to pay that cash back, right? 9 times out of 10, almost maybe 10 times out of 10, the company is not going to have that cash on hand to pay back the investor at maturity. So trying to structure these things so that they automatically convert at maturity is a really good idea and something that we try really hard to get through for our clients. In the food and beverage space, or the consumer goods space generally, you can usually tie the value that these notes convert at on maturity to some multiple of actual performance over the last 12 months performance, right? A multiple of trailing 12 months. That's a real value that's indicative of actual performance and is a good way to avoid that situation where the company is at maturity but has no cash to pay back those notes. So folks use notes because they're cheaper to document, right? Unlike an equity deal where you're probably going to be paying your lawyers somewhere in the range of $25,000 to $50,000, and where you'll also be paying investor counsel probably $15,000 to $25,000 from the deal proceeds. Notes are cheaper. You can probably get them done all in for $7,500. They're higher velocity in that they allow you to kind of sell them on a case-by-case basis. As you find investors, you can close on that money pretty quickly, as opposed to equity deals where you're usually waiting until you have some agreed upon threshold to make sure that folks aren't changing the terms as you go. There's a new instrument that folks are using called a SAFE, which stands for a Simple Agreement for Future Equity. It's an awful lot like a note in that it punts valuation down the road. It converts at some point in the future, but it eliminates many of the downside risks that are associated with convertible notes. There's no maturity date. There's no interest rate. It's not debt at all, right? It's effectively a prepaid warrant where you've agreed to buy equity at some point in the future, but you've already paid in your cash. So they're newer. They were born out of Y Combinator on the West Coast. They never took off on the East Coast the way that they did on the West, and for that reason, it may require more investor education to get folks to get comfortable investing through a SAFE. But we've had clients have great luck using SAFEs as an investment vehicle for taking cash and minimizing or eliminating a lot of the downside risks associated with convertible notes. The next handful of slides here are just a glossary of terms. A lot of them we talked about already today, but it's just a good resource for you all to have as you're navigating this landscape, thinking about equity, using it to grow the team, thinking about raising from outside folks. This glossary is a good resource to make sure that you're speaking the lingo, and that when other folks use terms that you may not have an understanding of, you can take a look at what's going on. And so we're almost out of time, so let's see what other questions we have here. Who accrues the benefit of the unused plan options? That's a great question. And the answer is everybody does, but maybe not proportionally, right? So if the plan goes in place on a pre-money basis before your investors have put their cash in, they've already gotten the benefit of the plan being in place, right? The price per share that they're paying has assumed that the full size of that plan is outstanding and has been deployed. And so they will have suffered zero dilution from the adoption of that plan. If it turns out that that plan was too large and you didn't need all of those shares, they are returned to the company, right? When we're thinking again about outstanding shares, the ones that have not been issued are no longer part of the calculation of what's outstanding. The result of which is everybody's ownership percentage increases proportionally, but the investors have already gotten that benefit, so they're getting the benefit twice. So founders often say, hey, can that go back to the team if it's not all used? And the answer is that gets hard to do. It's hard to do for a number of reasons, and it's not typical. So making sure that when you put that plan in place, that you're setting it at a range that is realistic, so that you're suffering only the necessary amount of dilution becomes important as you think through that calculus. Somebody asked about an LLC. If you're an early stage company formed as an LLC, would you suggest a type of stock for vendors, and what do you think of a convertible note for such? So everything that we talked about today sort of presumed that you were a corporation, but it all works with LLCs as well, right? LLCs allow you the flexibility to structure things really as makes sense for the operation of the company. And there's a lot of LLCs that structure themselves to look like corporations, so that they're issuing common and preferred units, that they're issuing options, that they're using convertible notes. Be careful though, because equity holders of LLCs are partners for tax purposes. So even if you're giving equity to service providers, it may be that those folks now become K1 partners instead of W2 employees. So you want to be mindful of that. All right. Can LLCs issue options? The answer is yes, they can. And in fact, if you think it's likely at any point in time that your LLC is going to convert into a corporation, it may be a good idea to structure things that way from the get-go. LLCs cannot issue incentive stock options, so the tax benefits associated with that might be a little bit differently, but for purposes of actually getting equity into the hands of folks, options work for LLCs as well. How complicated is it to wipe the cap table investing clean and start over? Incorporated 10 months ago, change mind. So it depends on how far you got, right? Because when you're issuing equity, like I said, if it's an exchange for services, the IRS is going to take the position that it's compensatory. So if there's real value and you're just issuing equity to folks without value changing hands, there may be taxable implications for that. That said, we've had founders decide that the original allocation among the team is no longer equitable, and the way that folks tend to deal with that is through some surrender type of mechanism where one or two or more of the founders agree that they're going to surrender a portion of their shares so that the allocation becomes more equitable. That requires, obviously, agreement and buy-in from the folks that are agreeing to surrender. Absent some vesting provisions that you've put in place at the beginning, you can't force anybody to turn over their shares. So putting stuff like that in place at the beginning becomes important. All right, I think we're just about out of time. If there are any additional questions, feel free to send them through, and I'll try to answer them as we wrap up here. But if there's not, and they come in later, feel free to contact me. Feel free to contact any member of the team, and we'd be happy to answer those questions offline. Please make sure to check out nutter.com. There's a lot of good resources there on equity, convertible notes, on founder agreements. By virtue of attending this webinar, you are now on the Food and Bev mailing list at Nutter, so stay tuned for additional content that we'll be producing in the coming weeks. But thanks for joining today. Hope that it was informative and answered the questions that you were hoping to get out of it. And we'll see you again in the future. Take care, everybody. Bye.